You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Bork. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Hey, good afternoon. Welcome back. Today is Tuesday, 26th day of March, 2019. Hope you're having a great Tuesday, whoever you are, wherever you are. Thanks for joining us. If you're returning, welcome back. If you're here for the first time, a special welcome to you. We're just glad you're here. I have a chart up of the S&P 500 E-mini. If you cannot see the chart, go to our homepage at cfrn.net. On the right-hand side, click the big microphone, follow the instructions. You will be registered in about 30 seconds. And not only does that give you one-click access to the show each and every day, the charts, the discussion, the chat, everything. We'll even remind you with an email, which you can opt out of if you want, but we'll send you a friendly reminder each day. Hey, the show starts at an hour. So wherever you're at, you can log in either from your desktop, or if you're out and about on a cell phone, just go to youtube.com/CFRN/live for the live simulcast. All right, fantastic. Thanks to the good folks at YouTube. The bell's not feeling well today. Okay. It happens.
Be tuned.
Yeah. Exactly. All right. We got a late start. I'm going to skip right over the little bit of news for now. We may come back to it in a bit. We're going to go look at the numbers. Let's see what they tell us. Let's pull in first data. Here we go. Starting in the U.S., cash market. Oh, Jesse Smollett. I turned it into a French thing. You've been Smollayed. But Jesse Smollett, all charges have been dropped. I know I said I'd go to the numbers, but it just popped up on my screen again. It's the big news, right? If you keep up with the Kardashians, you probably keep up with the Smolleys. All right, the Dow up 162 points. NASDAQ up 65. S&P 500 up 21. And the Russell 2000 up 13. In the commodity basket, crude oil up $1.15, trading 59.97 last. Now $1.15 in crude to a futures trader. We're talking cash markets here, but to a futures trader, you know what? That's a little over $1,000 per contract traded. And I would love to say that we actually caught that move on the alert last night, but wait. We did. All right. Moving on. Gold down $8.60, trading 13.14 last. Asian markets at the close, the Nikkei posted a gain of 451 points. That's a little over 2% for the Nikkei. Shanghai ended the session down 45. Hang Seng, and actually for the Shanghai, that's a loss of 1.5%. The Hang Seng finished the session positive, up 43 points. That's nothing but a hiccup for the Hang Seng. Mixed day in Asia, green day in the UK, and here at home, it is a big green radio Tuesday so far. Michael, if you're ready, we'll dive right into that recap.
All right. And can somebody type something in so I can put the link to the 1:15 meeting?
Oh, that's right. You got the meeting today.
Yeah, we got the meeting today.
All right. Well, let me hit mute here, and you can get on. Get on your way.
Okay. All right. I'm on my way. Let me get this one other thing over here. There we go. All right. Good afternoon, everyone. Today is Tuesday, the 26th day of March. Hang on. And the meeting link at 1:15 p.m. Eastern. Excuse me, at 1:15 p.m. Eastern time today is right here. Okay, that's the link to the meeting at 1:15 p.m. Eastern. And so we need to get in there. If you want to go to it, I'd be happy to show you everything that I got to go over. It's going to be these trade setups right here is what I'm going to be going over. Okay, those trade setups right there. Okay. All right. Now, as I said, good afternoon, everyone. Today is Tuesday, the 26th day of March, 2019. Today, well, if you have not taken a free trial with us, go to the home page at CFRN.net. Right over here in the right-hand column, it says 5-day free trial. Just go to apply.cfrn.net. If you click on that, it will bring you to this page right here, where all we ask for is your email, your first name, and how you found us. Hit the submit button. Once you hit the submit button, you'll be sent a confirmation link. You must click on the confirmation link. Okay? If you don't click the confirmation link, you will not get a free trial because we don't know you took the trial until you click on that link. All right? Okay. that said, I'll bring this over here and I'll go through the results. Today in the room, we ended up losing 8 ticks on the euro and losing 3 ticks on crude, making 10 ticks on gold and 6 on the ES. That put us at plus $95 this morning. I know, not a huge day, but a consistent winning pattern, or consistent profitable pattern. Today on the gold, we started out here, and on the first trade we picked up 2 ticks. The second one we picked up 8. That's where we got our goal for the day right there. We missed that one there, would have been a break even, and we took a break even right there. After that, you see, I wouldn't have done anything on the short side here or the long side because it wasn't really trending. And gold, a lot of times, gold is going to flatten out after 11:30. Gold and the euro usually flatten right out. And, well, it just broke dynamic support. It's starting to pull back a little bit. But that is that for now. Okay. All right. On the euro. We just had the one stop out right here. Then we were waiting and waiting and waiting, and then finally it gave one momentum long trade right here, and it popped up a tick, and then it came back down. No, I didn't do anything because it already popped up a tick. Then we had to wait and wait and wait, and then we get into the break, and we finally get a trend going here, lower highs and lower lows, and it looks like the only spot would have been right here, a short right there. Okay, that would have been a close down below this trend line right there. Okay. Now, all right. This is crude oil. It started out with a short right here that I missed. Now this one would have been okay to take because we had broken dynamic support right here. All right, so that would have been okay to take, but I missed it. If I did take it, it probably would have been a break even. We did get break even right there. Then we followed up with the +5 right here, and then a -8 right there, putting us at -3 overall. There was a shorting opportunity right here that I missed. Then it changed directions, and during the break, it was kind of messy here during the break. If anything, there would have been a short right here during the break, right there. Okay, and that would have been a short because it would have been a close down below that trend line right there. Okay. Now on crude, let's see here. On crude, I'm sorry, the ES. This is not crude, this is the ES. On the ES, we started out right up above or on top of the weekly trading zone. Then there would have been an opportunity right there that I missed. You know, I don't like trading when it's right next to the zone like that, so I usually don't. There was a trade right on the trend line here. We picked up 4 ticks on that. Then it got all sideways, and then we had another one right over here, and we picked up 4 ticks on that. This, you know, I don't have anything highlighted here because it was pushing in the high of the day, so I couldn't do anything with that. Okay, but we picked up 2 more ticks here to put us at +6. Then during the break, violently sideways, and that was it. That was it. So we lost 8 in the euro. We lost 3 in crude. We made 10 in gold and 6 in the ES to put us at +95 on the morning. On the month now, we're at 1723 over 16 days, averaging 107 per day. On the year, 5822 over 52 days, averaging $111 per day. If you have not taken a free trial with us, go to the home page here at CFRN.net. Right here on the right-hand side, it says 5-day free trial, apply.cfrn.net. If you click on that, you will be brought to this page, where all we ask for is your email, your first name, and how you found us. Hit that submit button, and you'll be sent a confirmation link. You must click the confirmation link. Okay, you must click the confirmation link. All right. And that's it. With that, we can pass it back out to fabulous Phoenix, Arizona. Studio A overlooking South Mountain, America's largest city park. Dwayne, if you are ready.
Indeed, indeed I am.
Excellent.
Recap of the recap.
Today, 27 minutes and 3 trades to get to $100 per contract.
Did you tell all the nice people that you're having that webinar today?
I did. I posted a link. It's at 1:15 p.m.
Okay, did you tell all the nice people how they can take a free trial?
I did that as well.
Okay. And did you remind those who are on the Logic 247 alert trial that there's a Q&A session this afternoon?
Oh, I did not remind them about that. There's a...
Ms. V, would you put that in the chat box, please?
It is at 6 p.m. Eastern.
Thank you very much. Yeah, 6 p.m. Eastern.
All right. Yes, indeed. Please put that in the chat box.
Okay. All right. Well, now these, just to clarify, folks, these are what you see up here. Last week's weekly trading zones. Okay. And when I break them out for the whole audience on Thursdays, as I do, and I think last week I broke them out a little early. But my point is this: had you jotted them down last week when I put them out there, don't think oh that's last week's news or last week's zones. Yeah, okay, but they have staying power. We opened right at a zone from last week. Sunday night on the Globex Open, dropped 19 points to the zone below, rallied 19 points back up, down, and yesterday on the show we mentioned that it looked like, because we were right here, because we had done all that counting, and we said it looks like what the market is trying to do, what price, because price is always trying to go to one zone, the zone above or the zone below. It's just how it's worked since December 14th of 2009, and I highly suspect that it was going on a whole long time before that. See, but the zones hadn't been put together yet. These specific zones in this specific manner. All right. So we did the up down, and it looked like the high probability thing to happen as price was moving down, because here's a secret. Here's the secret they don't want you to know. If price is moving up, guess what the highest probability thing is? That's right, it keeps moving up. Well, what about if price is moving down? What's the highest probability thing to happen there? That it keeps moving down. It will keep moving down more often than it reverses and heads up. And when price is running up, it will continue moving up more often than it reverses and heads down. That's why if you stand back and look at a chart of the S&P 500, the Russell, the Dow E-mini, the NQ, these best of breed indexes, if you can get a chart up daily, weekly, monthly, since the inception of those markets, you'll notice a peculiar thing. Despite dramatic days like when the S&P dropped from 1500 to 666, it was over a few days, but it's pretty dramatic, right? But did it change the upward trajectory? I promise you that chart you're going to look at starts in the lower left hand corner, ends in the upper right hand corner. Gold doesn't do that. Crude doesn't do that. Soybeans don't do that, because those are true commodities. People use them up, eat them, put it in the car, and there's a constant need for more, and true supply and demand can become a factor. Now, obviously there's demand in the S&Ps, or the price wouldn't continue to go up, and the Russell and the Dow and the NQ, right? but you're not dealing with the same kind of supply and demand principle that we see in those other commodities. If you have a bad corn crop, corn's going to get pretty expensive. But we've never had, since the inception of the S&P 500 Emini Futures, we've never had a bad crop, never had a crop failure. Never had a contract that, that contract just didn't work out. No, it's always the same. There's always an unlimited supply available, which means it really can grow to the sky. And that's all it's done since the beginning. So that was my point. Now, we get up to this zone from last week. After we do the thing that we talked about on the show yesterday, what's the high probability thing? The high probability thing is that this is going to be good support. And it was. And then the high probability thing becomes that it's going to go back to that zone overhead. It did. And consolidated for 1, 2, 3, 4, 5, 6, 7, 8.5 hours. These are 30-minute candles. And then the train left the station. And what's the high probability thing here? Because you're already above the Sunday night open. Zone overhead. Now, only 3 things can happen at a zone: consolidation, rejection, or the slice. Consolidation, most likely. Rejection, second most likely. The slice, third most likely. Only 3 things. Since December 14th of 2009, and probably a whole long time before that. So, what do we do when price just slices through an important price, important area, like it's not even there? We wait for it to pull back to the BBC, as it did right here, that red candle, confirm good support. How do we know it's good support? Because it rejected price and left that wick in its wake. From the open of this candle, 35, no, the candle opened at 28.30 and a quarter. Basically what happened after the pullback, we opened here, came back to the zone, got rejected again, right? So from 28.30 to swing high, 28.35. Now remember what I tell you, zones are an area, just like fibs. Yes, they print an exact number on your chart, but it's still an area. Sometimes you'll spike it, spike it, spike it, spike it, spike it, spike it, but it holds, right? Remember, it holds more times than it doesn't, all right? So we make it up to 27 to 30, that's an 8-point move, of which 5 points, according to our methodology, one might capture there. So now what's going on? Is the party over? Let's call in a trend line for just a moment. See what it has to say. It says that's a possibility. All right. Let's bring something else in. Ooh, what does that say? Now, I'll tell you what we were stalking in the channel. We've been waiting for this move to complete and retrace to the BBC. Because once it retraces to the BBC, one of 2 things are going to happen. It's going to hold, or it isn't. If it doesn't, then we have opportunity on the downside. And if it does, our highest probability right now is that the BBC holds, because it holds more often than it doesn't. So we have to wait and see which time this is. Then we have our high probability opportunity from, potentially 26, 27, up to 33, 34, which happens to be a very important area this week, and I'll tell you more about that on Thursday. So, or you can read between the lines. Bullish cross, leg, retracement, off to the races. We had an alert last night, 28.17 up to 28.19. Trail, if possible. That's what tip means. And so that move from 28.17 up to 28.35. Would that be 18 points, Michael? Actually, I don't know if he's still there. He had to get ready for his...
I am still here, but I'm working on something else. I didn't hear the numbers.
Well, I'm pretty confident. 17 to 35.
Yes.
18?
That is 18.
That's 18 S&P points times $50 per point. That would represent $900 per contract traded. Of course, the guys who trade 10 contracts, they can do the fast math in their head, and you can figure out what that might be. Now, there's 1 contract traders and 10 contract traders. How do you go from being a 1 contract trader to a 10 contract trader? 1 contract at a time. You see, what we teach in our methodology and our 24/20 blueprint, first, we want you to become consistently profitable before you even put live money into the market. If you can't figure out a way how to be consistently profitable in SIM, well, the thought of going live is just ridiculous. Let me tell you how ridiculous it is. When I left equities and stepped into futures back in 2005, I was told something very similar to what I just said, but I was really kind of having a hard time focusing and getting, cash flow positive in the SIM. but I told myself, I said, self, if you just went live with 1 contract, that'd make you sit up straight, you'd pay attention, you quit messing around, and you'd just be knocking them dead. So guess what I did? I wasn't consistently profitable, but I went live with 1. And I'll be doggone, it just didn't make me sit up quite straight enough and pay quite enough attention, because I still didn't find that positive cash flow thing. I pondered it, worried about it, and realized all I needed to do was just double the number of contracts I was trading from 1 to 2, because that would probably do it. Well, you can probably figure out how this story ends. When 2 didn't do it, 10 has to. When 10 didn't do it, I could trade other people's money. What? Are you serious? That lasted for like an hour. I realized that it kind of all became obvious at that point. It's one thing when you lose your own money. I mean, that hurts. That's painful. But when you actually lose $5 of someone else's money, someone that you care about, ooh, you come to your senses. So that's a cautionary tale, because I don't want to see you have to live in that land of peril, right? So that's why our 24/20 blueprint carefully says, stay in the SIM until you can put together 10 consistent days in a row of profitability. Then you gently step out onto the water with 1 contract. We'd like to see you then increase your account balance by at least $2,000 before you add a 2nd contract. If you do that, then that 2nd contract is underwritten by money you earned in the market. And that's a powerful dynamic. Now, it's not the house's money. Don't ever think that. No. And you didn't win it. No. You earned it. You were disciplined. You learned a methodology. You applied it. You worked it. And you earned that money. Now you're going to take some of that money you earned and underwrite a 2nd contract. The 24/20 blueprint walks you through steps where you increase 1 at a time. At the end of 24 months, if that's your goal, you could be a 20 contract trader. Now, we talked about this move here. The getting in, that was pretty simple. The alert just said, consider a long at 27.19. Riding it to the swing high, that's pretty tough because you never know it's the swing high until after the fact. But as it starts to come off, wherever you chose to take your profits, I'd say there was 18 up there, or yeah, 18. What if you caught 10? Okay. Well, on one contract, that's $500. On 10, you can do the math. On 20, you can do the math. Could you literally take over the world with 2 points a day? Well, that's probably a stretch, right? However, because of the great liquidity of the S&P, have a look at this. Yesterday, we did 1.7 million contracts. Also, I posed this question here, and we're up to 863,000 today, so liquidity, not an issue. Last night, right after Globex opened, I posed this question in the channel. I said, folks, what is the next high? What is the next high probability thing to happen, based upon how the S&P daily looks right here, right now? And I posted the chart, and the answer I got, and the correct answer, based upon our methodology and the narrative that I am currently in, was higher prices. Really? Well, yeah, but now I heard some other things which were all valid. Well, you know, the CFMA1's overhead, it's red and turning down. Okay. And look at your slingshot. That baby is below the 50-yard line. Red and falling. Okay. But nothing trumps this fact. Price is above the BBC. And as long as price is above the BBC, we anticipate higher prices. Until when? Until it gets below. And then we anticipate lower prices until when? You got it. Now, that may seem oversimplified, but step back in time. What if you'd employed that thought process since December 26th? Now, price rose into the BBC, but look what it did right here for January 7th. Closed on the other side. Okay? And then we begin this journey. And we did not get a pullback to the BBC. Price always pulls back to the BBC. We pulled back and touched on March 7th. Put in this beautiful little bullish candlestick signal here on March 8th. And then come March 9th, the low of this candle is, now this isn't a true bullish engulfing, but you can kind of see where I'm headed. It would have to be down here and engulf this. It didn't, but it's a very bullish candlestick signal. After this, that's a pattern. And then up we go. We didn't know where the exact swing high was going to be. No one can know the future. Not man, not indicator, not oscillator. So how did we know? Well, all we had to do was look left. We teach your kids how to cross the street, to tell them to look both ways. But when you're learning to trade, you only got to look left. See, we started expecting resistance right where we hit it. Pulled back to the BBC, dropped a little bit below it, came roaring back, which has now taken us to this new high of a 28.66. Okay, have we pulled away from this resistance? Has it lost its power over the market yet? No, because look where we are. We're right back in the thick of it. Price will need to pull away, pull back, hold this area on a pullback, then we can move higher. Until then, very much a possibility is that price could fail here. Could happen. And we could go back to test this low, the 24% retracement, or we could even drop back to the 38. Imagine that, going from almost 2,900, 2860, to even 2660. That's 200 S&P points. That's 2,000 Dow points. Would that harm the uptrend? Would that harm the bull market? No, it would make it stronger. The deeper the retracement, the better opportunity you have for the next leg to potentially match this one. Now, think about where that would put us. If we were to get a duplicate leg from this low, which was at 23.20 to 28.64, now let's just round that, 500 S&P points. So, are we talking 3,400? Yeah, I mean, I don't even know if I can scroll that far. Is that possible? Yeah, it is. After everybody thinks the sky's falling. Wow, what if we pull all the way back to the 50? Imagine that. It could happen. I don't see us going back to 666 yet, but hey, you might as well embrace that because that could happen as well. Here's the Dow. Last night on the Dow, bullish cross, price pulled away, price pulled back, up, close, and away we go. We went from 25,680 up to 25,815. And the alert for that one, let me find it, bring it up. Hang on for me a second, guys. Okay. Let me scroll up. Hang on. YM last night. Oh, was it the ones that carried over? Might have been. Let me look. Let me look. Yep. Oh, there was that one too. Yeah. Okay. It's been a great week. I hope you've been in there to enjoy that with us. So here's, you know what? I didn't do the Dow. There was something funny about the Dow. Didn't do the Dow. Did the S&P 28.17 to 28.19, and then we said, you know, person might want to consider being long the NQ 91 to 74.01. That's a $200 per contract move. Let's see what it did do. Okay, you'll notice bullish cross, price pulled away, price pulled back to physically touch, up close, and off it goes. All right, that one was 73.91, which is going to be about right here ish. 73.91. That's pretty close. Yeah, 73.91. Now target just 74.01. 10-point move, $20 per point. That works out to $200 per contract traded. But let me ask you this. If you were watching this chart, this 30-minute chart, and you saw that down here you were blue and above the 50, and you were blue and climbing, and you were printing this green candle, would you get out of this? I mean, you probably waited a long time for this to manifest. It's one of those effortless kind of things. I could go into a lot of details about why it seemed effortless, but not enough time for that today. So, from 73.91, we ran up to 74.47. There's a weekly trading zone at 74.80/81. That's way up here. And the one below that is at, oh, I'm sorry, 74.18/19. So we spiked that. Now the exit signal prints here at the close 74.11. Sometimes the exit signal, if you need an extended move like we had over here, this was semi-extended, but they spiked the zone, gave it up. Now look, remember I said the BBC holds more often than it doesn't. This is why we don't take action. This is why we don't just park an order and go golfing, you know, and hope when we come back that we've got a cookie. No, we let the market show us before we make those kinds of decisions. Look what's happening here. Through that trend line, BBC, dropping right through. Hey, Michael, I think John is here. Could you open him up, please? If you're still here. Oh, no, he had to go do his thing. So let me... I'm coming, John. Hang on. Hey, John, welcome to the show.
Hi there.
Sorry we missed you yesterday.
No, you were...
Right as I signed off, I saw you were coming in, and I couldn't reverse it at that point.
No, it was a very busy day. Listen, we actually did pretty reasonably well. We kind of reversed down at the bottom a couple of days ago, and then the market started rallying yesterday afternoon, which was encouraging. We had a pretty good overnight rally. However, I've been thinking to myself, today is the 26th of March, and we had this first sell-off followed by this rally, and I would say breaking down from this rally right now is a very bad development, because there's the underlying, even though they were kind of, trying to prop the economy up this morning, there's this fear of this inverted yield curve, out there.
John, I know that a lot of people in the audience have heard that term and possibly don't really understand what it is. Could you take just a second and explain what the inverted yield curve is?
It's when you get a higher, on the short-term money, like 1 year, 2 year, 5 year, when you get better yield, you get more money from putting money short-term than your long-term.
Okay, now
So,
what
in other
causes
words,
buyer and sell? Because that's a reflection of buyer and seller sentiment. Why is it that people right now? Why is short-term money cheaper?
I guess you look at the bonds. You see, we're back up to 140. We're just about to crack 147, I think. Oh, wait a minute, I might be.
Hang on, I'm going to bring up bonds right here. ZBM9. Here's a 30-year bond.
Yeah, 148, 149 actually on that. I was looking at the expired contract. So, I mean, this is a pretty big deal because, when the bond market, when the demand for money is going down, what it's telling you is it's kind of saying that the long-term money market is kind of, the yield is going a lot lower than people thought. A few months ago, they thought it was going to be, we're going to break the 3%. Now we're down to sort of 2.5. It's kind of telling the Fed to lower rates. It's exactly what we said months ago. I mean,
exactly what you've said repeatedly, and over the last 48 hours, I've seen it repeatedly on websites, on financial news shows. Everybody is jumping on your bandwagon there.
Thank you. Well, I think, to be fair, you really heard it here first a long time ago. I mean, we were talking about this 6 months ago. Remember, we said that the odds of a week, by May, the Fed could be actually lowering rates by May, and that's a real possibility now. They better do it because I think they're going to, if they want to, if they're on the same page as the president, they better get cracking, because time is running, time is moving towards the 2020s, and they need to. The worst thing in the world would be an economic downturn from here. Would be because trying to turn around a downturn is a tough challenge and tough assignment, and you don't want to have another 2007 again. So I mean, look, this is the longest expansion in history, almost, and unfortunately, all expansions eventually end, but I think this one has got the potential for another 2 or 3 year wind, at the back, if you like. But I'm pretty, as I've said before, the early 20s are going to be fraught with danger because the first, the early years of every decade generally are pretty choppy. If you, I mean, look, you had the 30s, you had 1930, 32. 40 to 42, the beginning of World War II, we didn't turn around until 42 and a half, until the day the market turned in World War II was, I think, when the bombers went in and bombed Japan, and they started getting the upper hand, if you like,
John, can you keep talking? I'll be right back.
Yeah, in fact, it's kind of interesting because the market predicted the end of World War II 2 years ahead, 2 years ahead of time. So then you had the early 50s and had the same thing, and you had the early 60s, you know, that Kennedy bounce, and then the market took a huge hit before it had the fantastic 60s, which were basically driven by the space age 1.0. Then you had the early, you know, they had a big rally into 1973, and then you had the crash into 74. It was a little bit later. You had a kind of an early, you know, really the market didn't really get much higher. You know, by the time we got to the 1970s, that was about it. And then it had a steep downtrend in 74. By November 74, the market turned, and the Fed stepped in. And of course, at that time, people didn't pay attention to what the Fed was doing with the intensity that it gets today and the coverage that it gets today. It's a whole different ballgame. But my theory is that we're reliving the 70s in a lot of ways, because our crash, if you like, market crash was 2009, and we're in an elongated recovery where the Fed has done 10 times, you know, to the power of 10 what they did in the 70s. Now, the end of that, the fallout from that was the gold price going from $104.6 in 1976 to an eightfold gain to $875 by 1980. That was sort of what the Fed did, was eventually reflected in inflation and higher interest rates, and that's something to consider. Look, we're probably going to get a weak, you know, I would call this a weak spot we're going into right now. And the Fed they kind of look, they haven't said they're considering lowering rates. They said they're in a kind of a stay the course time of scene at the moment. They've given themselves one rate hike in 2020, which probably won't kill the market, I don't think, but they haven't really left themselves any room for an ease at this point, other than that they're in a dovish kind of a mode. The one thing that might happen, which we've talked about, is the market could get a second wind later, going into the summer, possibly have a pretty big rally, because if you remember, we've had a huge rally in the markets, almost back to the all-time highs in the last 3 months, and that's sort of signaling a rebound in the economy ahead, but it's quite a ways ahead. It's later this year, so it's hard to say whether there is a chance that we could get a lot of pickup in the summer, because don't forget this. Look, the Chinese have been stimulating now for 6 to 9 months, which means the Chinese economy could rebound pretty strongly, and as could the rest of the world's economy. They're all in a kind of a weak spot, but in a certain way, the world slump, if you like, has been much longer than the U.S. downturn, and it's not even a slowdown. It's just a kind of a Goldilocks type economy. Apart from the jobs Crude number could be indications of a slowdown, a few things like that, but generally speaking, if you compare this to where we were, in the 1% age of the Obama, a lot of the Obama, first quarters, we're in a very good place right now. If we're doing 2.5%, we're doing great.
You're right, John. We've done so good that even if we reverted right now to a quote unquote normal economy, whatever that is, it wouldn't feel right, would it?
Right.
And think about all the millennials. Think about all the millennials that have never known what true interest rates are.
Yeah.
Think of all the money managers on Wall Street that have never traded a bear.
Yeah. Don't forget, you've got this unbelievable pent up. They were sort of on autopilot in a lot of ways, where the economy is pretty strong. If they throw a bit more gasoline on the fire, it could really rev up. There's the possibility of an infrastructure. There's continuing money coming into the country. Look at the dollar. The dollar, one of the reasons the dollar is probably so strong is because all this money is coming back from overseas. And then the investment from overseas, that's continuing. So we certainly are in a very good sweet spot right now. And there is a chance that the momentum, especially if the world recovery gets back on track, and and I do believe there's a chance of the dollar breaking down here, not necessarily right away, possibly within a month or two, and that could really ignite the markets, the U.S. markets, and the metals for that matter. So the way I see it is, you could get there's after we get out, if we get out of this sort of slump that we're in right now, and start picking up into the summer, you could see interest rates start to rise, possibly quite dramatically, because think about it, we've had a pullback to about 2.5 or whatever, maybe a bit less right now, and if the bond market starts strengthening up, the market's going to get inspired by that, because the market's going to perceive the economy is getting stronger again. And this time, when it goes up to 3, you might break that 3 and get into a whole new ball game of higher interest rates that could be kind of self-fulfilling. So that in that instance, you could see the fear of inflation coming. It would be a reversal of the inverted curve. So long-term money would start to yield stronger. So that the fact a reversal of the inverted curve, and this guy called Mohammed, the Mohammed El-Alarian from Egypt, the Egyptian guy who's at Commerzbank or something like that, one of those outfits. He's pretty good, and he was saying that he doesn't, he sees the economy getting stronger again. So
I saw someone yesterday, and I meant to jot it down. They were talking, and they're talking about quantitative easing coming back.
Well,
this is one of the highbrow, educational economist type guys, not some trader just running his yap. And this was like a serious guy.
Well, look, if the Fed did lower, if they lowered a couple of points here, maybe they overdid it last year. They could lower a couple of times going into the summer. That would really ignite the economy, I think, and would probably set us up for a pretty good run into 2020, and and getting into an easing mode would be very, very bullish at this stage. I mean, it would be perfect timing to start easing, and they may be justified in doing that, but I think the economy would respond, and it would sort of set us. There's a few people out there like this Sugarrod guy, who's Steve Sugarrod. He's pretty smart. Ran a hedge fund in the past. I think he's a very shrewd market analyst. And the Stansbury group that he's associated with, they're talking about a huge rally into the, which I agree with. I think the potential is there for another 10,000 point upside from the lows that we hit just after Christmas. Now the question is, are we going to retest those lows, or are we going to hold in here or pull back a bit? If we start pushing higher from here, into April and May, I would consider that to be pretty bullish. And I think if the Fed did get into an easing mode, it would be potentially very, very bullish, and it would probably be very bullish for the metals too. So because at this stage of the game, when we're getting towards the end of a major expansion, there is a time when gold and the markets go higher together. And just as a reminder, I mean, I really think you can feel that we're in 2005 in a lot of ways, because in 2005 the gold bottomed at 425 in the first quarter, and there was a lot of hand wringing over that and people throwing in the towel, and literally within a couple of years you were breaking 1,000 on the upside, and the market was up substantially as well over that period. And that's when all the banks got into trouble. Remember, in fact, you and I on this show, we laid it out in December of 2007. We basically said it's going to be up for the first 6 months of the year, and then all hell's, then it's all over. All hell's going to break loose. Right. That was. I mean, it's in print somewhere out there on the net. I wrote a kind of whole thesis about it in December 2006, and it was very, very dramatic period, and obviously, listen, if it wasn't for the whole system nearly went down, and there's probably 30 trillion or more being pumped into the system, and that ultimately is going to show up in unforeseen consequences, most likely highly inflationary over the coming few years, especially going into the early 20s. Just as I was saying, we got up to the 1970s. Remember, in 1980, we were down for the first couple of years into 1982. We bottomed August 12th, 1982. Started a mega bull market, but guess what happened? Got into the 1990s, and had a big correction in 1990. Hit an all-time high at 3,000, first time over 3,000. Had a 20% correction down to 2,400 or so. And then January 16th, 1991, had the biggest opening gap in history, the start of the Gulf War, and we had a 9-year mega bull market, the greatest, until today, the most, certainly the greatest wealth building bull market of all time. And, the internet got free, it got invented, and the communications was what do they call it? Deregulation.
Deregulated. Hey, did you get a chance to watch that Valley of the Boom yet?
No, I didn't. No,
it's all about Netscape, and I know how you've got some very strong feelings about the whole Netscape Navigator thing and how that went. Yeah. This is it's a documentary, but done more as like a TV show. It's really entertaining and informative. There was so much stuff. I thought I knew everything about the birth of the internet. Apparently, I did not. But now I know more than what I did know. So. Sure.
So, if we turn here, we could go the way of that arrow. So, it's, we're kind of at a very important point here because, further breakdown from here would be a problem, I think. And if we can get past it, that would be, and get, rally into the end of the month, that would be pretty impressive. But, we're going to show a pretty strong quarter for March, one of the strongest quarters ever, actually. So, is there going to be continuation, or as we've said on this, we said a week ago, the market could go a little bit higher, and on that double top you just showed, and then it could go down a bit.
Oh, and then, on which market, John? On
the one, that one there. Yeah, but as you can see, look, the logical thing for it to happen here is we get a kind of a right shoulder where we pull back possibly the 2,700, 2,750, but the market's been so strong, you just don't know whether it'll do that or whether we're going to break out to the upside sooner rather than later. You just can't say for sure. The more than likely is there's probably going to be a correction, going into April, May.
This thing is, although we just had, a couple of shallow pullbacks to the BBC, that keeps it going a little bit further. But we've not had a pullback even to the 24% fib since December 26th, when this thing took off like Santa's rocket ship.
Right. So we got
now. Let me ask you this, because I know you got a really good memory, photographic it seems. December 26th of last year.
Right.
What was your feeling? What did you think? Did you believe that this would lead to this?
Well, I tell you, I think I mentioned it on the show. I have a friend who's really, he's an ex-floor broker and market maker. He's a very sharp guy. And I remember him telling me, in 2017 when the market was going like straight up, and we went up about 5,000 points from August through January of 18. And he said, there's probably going to be a big correction off this, when this ends. But he said, you got to buy that correction. When that correction happens, you got to buy that correction because the market will rebound very strongly. And I certainly had that in my mind. And if you remember, look, the hardest thing in the world is, when it really does look like, it was a really tough correction to get through because it kind of broke a lot of norms.
Here's 2017. I finally tracked it down. Here's January in the bottom left, and that's all of 2017 right there.
Yeah, pretty incredible. Huh?
To there. Yeah.
Yep.
And look at that break.
Wow. It's interesting. It's interesting. Look at that. Look, whenever you see, this is a little tip for everybody. Whenever, and by the way, this kind of happened in the bottom. The opposite of that market, what you're looking at right there, happened, going into the March bottom of 2009. Okay? In other words, you know, you had a couple of rallies in 2008, and then you had then they nominated Geithner as the Treasury Secretary and had a big rally late 2008, and then and the problem was, as I've said before, the Dow was losing 400 points a day, you know, quite frequently, and that was you know, difficult to deal with. And I remember, and I think Joe Granville, when he was still alive, was saying, you know, the bottom is in 2008. I said, no, it's not, Joe, because we were hitting, you know, we're crashing, and the breadth was making new lows. You can't make a bottom when the breadth is making new lows. And what really happened was, you know, and of course after Obama came in 2008, there was if you remember, right after he was, you know, inaugurated, everybody thought the market was going to go up, and it literally went down for the next couple of months going into March. So that was very difficult, you know, psychologically to deal with at the time. However, as we were going into the early part of March, first thing that happened was the overseas market started bottoming ahead of the U.S. The Russian was the first market to bottom, and incidentally, for those who are interested, it went up 400% off that bottom. Bottomed in January, first few days of January. And remember, Russia had a monumental, you know, 100 times upfold before that, and then crashed along with us into 2009. Then I think the Chinese markets, some of these other markets started. And look, the strongest stocks started bottoming. You know, Keurig Coffee was one of the first leaders. Some of these things hardly had a correction. They were. I remember looking at these things making new highs, like Guitar Center and Keurig Coffee, and you sort of scratch your head and say, "How are these stocks making new highs?" You know.
What about that, you know, Green Mountain? What was it? Green Mountain Roasters. That thing was on fire for a while. Kind of thing.
Yeah, exactly. So, you know, when you see, even though it's hard to get your arms around these things, you know, when you see, it's just like, I mean, what did I say about a week ago? I said when the market was actually at the highs, when the day that BIIB, what's that one? That stock that got cut in half.
Yeah, we looked at it the other day. We'll look at it again here.
Got savaged, and literally that was enough to scare all the funds into selling, and that's what kicked off this downturn, because, you know, that's a widely held stock, and it resonates, you know, when they come into work and find that they lost, you know, most people are probably losing big on that stock. So
is it BIBB?
No, BIIB, sorry.
Okay, there we go. I got it.
Biogen, yeah, Biogen. So that really knocked. I mean, look at it. You know, jeepers, really knocked the market down.
Wow. Now it's closing in on where it opened on that fateful day.
Well, usually, you know, a lot of times what happens is it goes back and tests the rally or the gap, and then the next downturn you probably want to sell that. It's kind of like Facebook. You know, when Facebook dropped massively, it basically you know, set off that correction, and it kind of warned you how serious it was, how bad it was going to be. So
let me ask you something, John. I'm not a pattern guy. I recognize some of the obvious stuff, but is this a cup and handle potentially forming here? I see the cup. Where's the handle? How does that work?
Well, look, I mean, you can never say never. This is a pretty strong company. I mean, it was.
No, I'm just asking what the pattern looks like. See this where it gap lower right here? See this?
Yeah.
What is the handle going to look like over here? How do you know you got a handle?
I don't know. I think you just have to wait and see. You know,
okay.
The thing is,
why I'm not a pattern person.
It might have been a bit overdone. This, I mean, remember before Facebook crashed, you know, it kind of rallied off that big gap. You know, most of the time, a really big gap is almost overdone. A guaranteed. Yeah, but never. You know, in this instance where it's a failed study, you know, while there was probably a lot of expectations for that study, it's probably not that big of a deal in terms of the regular business of this company, because it's a futuristic thing. It's a future thing. You know what I mean? So there might have been a lot of expectation built into it, but in terms of I mean, if you have to ask yourself, did the stock get to $380, $400 on earnings or on expectations of this study? I would say it probably got there on earnings. You know, the expectation of the study was, you know, So in this instance, it may not be such a bad, deal, if you like.
I don't remember us talking about Theranos back a couple years ago when it was like the big thing. Did you have any thoughts or feelings regarding Theranos?
Well, I think we talked about that. If you remember, Carla Slim got involved, and she had a, Kissinger, Josh Schultz, the former Secretary of State.
She had the biggest board of heavy hitters there ever was.
Yeah. So, I remember when the Wall Street Journal started exposing this story, it was kind of a bit of a shock.
She fooled
it seemed, well, yeah, look, it seems, what I think, the reason why this thing was such a clever idea was because of the pinprick idea where, everything could be done in miniature without all the drama of getting a, regular blood sample, which frankly is not a big deal,
Right.
It takes, I remember one the other day,
but one drop, there's supposed to be like 100 tests off one drop.
Right, yeah, and it just seemed like a logical, progression towards miniaturization that goes on with everything. So I think that was a very logical kind of an idea that everybody had, and it's almost like a no-brainer. And of course, turned out that it it's not. At least it may be possible in the future, but it's not. Maybe it was a bit ahead of its time.
See, it was one thing for her to fool investors and fool her board of directors but when they put those things in Walgreens and started actually doing tests on people, and she and others at the top knew this thing didn't work. That's kind of reprehensible.
Yeah, no, that was for sure.
Okay, now listen to this. I'm getting ready to sell my pickup truck, and I was cleaning out the glove box a couple days ago. I found in there a form from the last time I had a liver function test about 5-6 years ago. Guess what company name was on that form? Theranos. So I have no idea if the results I got back, which were good, were actually even good. I don't know that they even tested it because, yeah, I was a victim of that thing. Not with the blood, but crazy. Stuff. Guys, if you don't know the story of Theranos, there's a podcast out there. Just Google it. It's called The Dropout. It's in Apple iTunes podcast. Listen to that. It's 10 episodes. Really, really good. Go ahead, John.
Yeah, the 2020 had a good
right. Yeah, I saw it.
They did a thing too. Listen, I think we're going to reverse back long on the markets because we went short this morning. Earlier, I didn't get the top this time. I was kind of preoccupied, but I took the caution of just reversing positions, but I think I'd go back long right now. And actually on our contingencies, yeah, I think we already reversed on the contingencies. So, but however, I would sell, I would sell a downturn. I would probably sell, like if we went through the 1 p.m. lows here, I'd probably reverse back down again, but it does look like it's reversing up here. So, since we've only got a few more days into the end of the month, you can't rule out tomorrow, okay, Wednesday, Thursday, Thursday and Friday. Thursday could be a big rally day. Thursday could be the defining day on whether this is going to keep going or whether it's going to turn.
What's happening on Thursday?
No, second last day of the month. That's sometimes
it's
a big deal. So,
I thought maybe there was some big news coming out. There wasn't a lot of news, so to speak, this whole week. See, tomorrow's Wednesday.
The funny thing is, the telling news, if you like. You don't know when we had that big sell-off on Friday, whether people were expecting the worst of the Mueller report, and the fact that the market didn't rally on the Mueller report was a little bit of a departure from normal kind of behavior. Especially, there was a bit of a rally on Sunday night, and then we went down into Monday.
I think the buy the rumor, sell the fact there would have been if Mueller had found him guilty of something. I think what we got was kind of just baked in. The market just shrugged it off.
Yeah. Sorry, just a second.
Go ahead. Okay, guys, I've been chatting with the folks in Telegram, and I just want you to understand this dynamic. Remember what I said about price, as long as it's above, right? Okay, here, did we get below? Yeah, but look at that wick. We pulled back. All we did was we overshot the BBC, and we almost touched this zone from last week, which we already know is good support. Now, when we think about this dynamic, okay, all these people lined up here for 1, 2, 3.5 hours before it took off. Then it went from 28.14 up to 28.35. Off the top of my head, that's a lot. Okay, so as price comes back into this area, some people think, well, if it did it once, it could do it again, and that's true. So why didn't they wait for price to come all the way down here? Why did they come in and start bidding it up right here? Because they didn't want to get left behind. Trust me, there were some people who missed this move. It's okay if you're self-employed, but if you're working for a big trading firm, you probably got called on the carpet. What are you, crazy? You missed that? How obvious could it be? Yeah, well, sorry, boss. I'm not going to miss it this time, though. I'll buy my ticket early. And guess what? Even if we don't get back to 35, what if we only get to 34? Now, why 30, not 26, 27 last week's zone? Because I know as this comes down through that zone, it creates a wall of potentially good resistance. It's confluence, congruency. It's the CFMA1 red and falling, crossing that WTZ. Price could pop right up, stall, and roll. If it does, no harm, no foul. If it powers on through, remember, the closer it gets to a zone or a previous high, the greater the likelihood that you'll actually get there. So 30 to 34, there you go. Now you know all my secrets. Any questions? We do have a Q&A session this afternoon for everyone that's been on the trial, and it's been a great week, you know. Somebody asked me a question yesterday, and this is a question that always comes up, as it should. And the question was, when does a person know to call it quits for the day? You know, do you have a hard number for your loss, or how does that go? And my answer has, no, I don't want to say it's changed over the years, but I think I might have found a better way of wording what I always say. And that is stopping for the day. If it's a function of money, you are undercapitalized. So you need to reduce the number of contracts you're trading, or go back to sim until you can replenish your capital, right? The only clear reason, once you have a definable edge, and you're experienced at applying that definable edge, the only reason really to stop would be inhospitable market conditions. If market conditions are good, you're right back to it's a business based on probabilities. Go ahead, John.
Yeah, there was a question you asked earlier on about the bottom. First of all, just to finish my longer term thing, which
yeah, go ahead.
We got to the 1980s. We had that low in the early 80s. Then we finished, we were new high by 1990. Then the low, and then we had a great decade in the 90s, and then guess what happens? Early 2000s, just like the early part of the 20th century, 1902, 3. There was a crash in 1903. There was a crash in 2002, 3 in the early part of this century. And then we had a rebound towards the end from 2009 into 10, 11. And then next thing you know, we had another pullback in 11, 12 before, the runaway success of this decade, with a punctuation in the middle in 2016, 2015, 16. So the odds of us rallying into the end of this decade are very high indeed. It's just been a tendency, in all past decades, so that's a very strong trend in of itself. However, you really have to be on guard. Look, I really believe if Trump is reelected, and listen, there's no guarantees on that, even no matter how good things look today, you never know what's around the corner. But certainly, the way things are looking today, it's certainly his chances of being reelected probably were elevated substantially in the last few days. With
John,
this,
with as many people and as many agencies are investigating him and threatening to investigate him, he'd have to be Jesus not to be guilty of something.
Well, you know, that's the problem. You never know what they're going to uncover. So, I mean, you know, and how it's all going to work out. You have to, but I think the odds are very favorable now, especially if the economy is really strong, that he will not just get reelected, but it could be a landslide. Because I think people are really kind of tired of this, you know, fiasco that's been perpetrated on the American people over the last few years, and there may be a lot of fallout still to come. You know, because when you compare this with Watergate, I mean, Watergate, you know, was a couple of burglars, you know, 4 or 5 guys went into the Democratic headquarters. What they did here is basically they did a Watergate to the power of 100, and you know, and weaponized the government, you know, to carry out the whole thing.
That's so old school. You have to go someplace to rob it. Now you just rob it from the comfort of your own home or office.
Yeah, and not only that, but you know, getting the whole, you know, deep state, if you like, against, you know, to carry it out. And you know, it all, the big thing is that it all leads to, you know, everybody knows where it leads to, and that's the big, you know, the coming drama that could unfold is how the puppet master made all this happen. And that's why they've been frantically trying to perpetrate this story to cover up everything they did. So, you know, there could be some real bombshells come out of this before it's all over.
Has anyone ever confessed to being a part of the deep state, or would that be too egotistical?
There's a book, you know, for George Papadopoulos is publishing a book today. His book, How He Was Targeted. And it's probably a pretty accurate read of how this whole thing kicked off and how he was a kind of an unwitting, you know,
participant,
target. Yeah, participant.
Well, let me ask you, even if someone wouldn't publicly admit that they're part of the quote-unquote deep state, in their own mind, I mean, could they go, yeah, that's me, and I'm doing something for the greater good, my own good? What is the purpose of the deep state? What is their agenda? What's their manifesto?
Power, you know, power, and you know, getting. I mean, listen, you know, they basically accuse Trump of rigging the election. That's been proven, you know, that didn't take place. Now it's absolutely 100% certain it was a free and fair election. Right. You know, of course, they tried to, because of the, you know, I think the surprise was, you know, Russia was. I mean, at the end of the day, how much did they influence the election? In a minute way, possibly even not even countable. Did they swing a few votes? Possibly, but you know, there's absolutely no way this thing was rigged. However, it was heavily rigged against Trump from day one. You know, period. I mean, that's the real story.
That's the real story, right?
I mean, it really is.
But now, should the Republicans spend $25 million to uncover that, or should we just go back to business, go back to work?
You know, if the Democrats backed off right now and just, you know, everybody got on well together, and there's no more of this venom being spitted out everywhere, I probably think the Republicans would you know, just call it a day. But if they, you know, if they're carrying out the way they are, you know, they got to fight. You know, I think that's going to become a very big deal, and they may end up being the casualty. They can't see beyond their nose right now, despite their face. So, I think you know, and I think they're going to shoot themselves in both feet before it's over, and they've probably already done that anyway. So, and look, a lot of these people who got voted in the midterms, I mean, there's a historic trend. The midterms are often a reversal, and then it goes back to the others in the next election. And there's a very strong possibility most of these newbies will be voted out, and possibly some of the oldies as well. You know, so I mean, look, you had a lot of Republicans step down from running. Why did they step down? Because the writing was on the wall. They didn't even want to be embarrassed to get in a race that we're going to lose.
And plus, it splits the vote.
Right. So, come 2020, if the economy is doing well, and if Trump, I think Trump. Listen, Trump's he's made some mistakes. To me, the most unforgivable mistake really was putting Jeff Sessions' seat at risk. Was a little blasé. It was a little bit, how do you say, it was an example of overconfidence. They thought that was a safe seat, and it had very serious, mind-boggling implications, because if Jeff Sessions had never been the AG, there probably wouldn't have been this witch hunt, and especially if Chris Christie was the AG, and secondly, that seat they would have 54 Senate seats today, and last time around, that seat would have defeated John McCain. So that whole, and that was the linchpin to the Dems winning the healthcare. They went for healthcare in the 18 elections, which and they won on it. And by the way, this morning a poll came out. The number one theme of the 2020 is immigration, and the second biggest theme is healthcare. So the healthcare is still a very big deal.
Did you hear what Obama said yesterday? He's been relatively quiet since he left the White House, but he made a statement. He made a statement yesterday that this may be the smartest thing he ever said. He was addressing all these freshmen in Congress, with their wild ideas. He says, I'm glad to see y'all are thinking, but you need to figure out some way to pay for it before you bring it to the table.
Well, good for him. That was,
that's like, he should have done stuff like that when he was president. But anyway, you got to figure out how to pay for it. Oh, pay for it? Because this is an entitled generation that we have here. The OCAs or whatever name is, and all the others, they don't know about economy. I think she comes from money, doesn't she?
I think she's got, and this Beto guy too. I think he's got a billionaire uncle. Okay. So he's got a lot of backing.
So they don't know what it's like to not get a bicycle at Christmas when you're 10 years old.
Yeah, exactly. Just because you asked me the question earlier on about the December 26th, which. Right on this show, you remember what I said? It's sort of like the March 6th. What defined the March 6th bottom? And I was coming to that. The biggest takeaway in being able to pick that bottom to the day, even the hour, which we did, was being able to notice that the Dow was not falling 400 points a day going into 2009. It was only falling 400 points a week. So the downside was decelerating, and that was the biggest. Not only were you seeing these early stocks popping up, making new highs even, you were seeing the Russian market taking off, and then the day, the 6th, and on the 6th of the biggest thing, look, very often, 9 times out of 10, whenever the NASDAQ is outperforming, that's, you can pretty much bet on that. But the problem with that bottom was the NASDAQ didn't outperform that day, at least, on spec. In other words, as you were looking at that day, you're scratching your head and saying, the NASDAQ isn't kind of acting here like a leader, but beyond the veneer, believe it or not, it was. And how do we know that? Because in all the drama of the early afternoon of March the 6th, which is kind of seared in my brain, you had that analyst girl, I forget her name now, she came out and the Dow was at 6,666.
Right.
And she came out and said the Dow is going to 4,000. Somebody else said the Dow is going to 4,000 that day, some big wig, maybe even Warren Buffett, somebody like that. And it really spooked everybody. And but the takeaway was, and what happened was that what sort of triggered this drama was the S&P made a new 12-year low, not a 9-year low, a 12-year low. that day. But guess what? The NASDAQ didn't. Okay, the NASDAQ didn't even get close to its 2002 low, which was in the 850s or somewhere like that. And that was the clue that told you that the market was stronger than it looked. And in addition to that, you know, that particular day, I think the Dow was the worst of it, was about 150 down, maybe a bit, not even as bad as that. And towards around about 3 o'clock in the afternoon, we kind of went into a bit of a lull, and it just didn't seem to want to go any lower. And then at 20 past 3 on the afternoon of March the 6th, we were short, you know, from early, you know, from virtually the inauguration downwards. And we covered our shorts at 20 past 3 on our alerts. And by 20 to 4, the market had turned and it was starting to go positive. It hadn't gone positive yet. And we basically we covered our shorts, and by 20 to 4, we went to 100% long, and the market went positive before the close, and that was it. That was the bottom. And then there was a little bit of a repeat on the Monday, or whatever day it was, March the 9th. There was kind of a little bit of a retest. And then the market made a very dramatic turn and started gapping higher. And it really kind of took off and ran up into April. And by sort of late March, we actually came out and said, didn't say that all the market was going to hit new highs by the end of the first term of Obama, but we did say that we thought that the mid-cap and the transports would hit a new high within 2 years, and that effectively happened. I don't want to get into all the reasons why I came up with that idea at the moment. Well, that's for another day. But you know, something similar happened in the bottom in 2002-3. You know, we had that final sort of, it had several bottoms. We had 3 bottoms in 2002. We had one in August of 2002. We had one in October, and we had one in March 2003. It's kind of like a triple bottom. And the transports and the mid cap took off, and and I actually said back then, thought we'd hit new highs before the end of the year. That's what we did. So we used the same theory again in 2009, and of course, right after that, they did hit new highs. Was when we got shellacked in the early 2011, when the market suddenly dropped 20% from about July the 5th or so of 2011. Market literally dropped almost 20% it was going down 1% per day almost, you know, for a couple of weeks. And it was, you know, but then it stopped, and then, you know, it kind of went sideways into the October bottom, the October 4th bottom of 2011. That was when the Fed, the European Fed, stepped in to bail Europe out, because it was because of fear of the European banks failing and everything that caused this whole thing. And you know, we were stronger than that, but Europe was really dragging the whole world down. And so we went through another kind of like scare, you know, a 2009 repeat. And incidentally, just in the same way as gold has been exhibiting the same pattern recently, the craziest thing is we hit new all-time short position. You know, even though we think about this, the transports had gone up to new highs, new all-time highs, and the mid-cap, and yet the Dow, the short interest on the New York Stock Exchange, hit an all-time high right about October the 4th of 2011. You say, how can that happen? We were way above the 2009 bottom. And it just, the way the world works. And that short position, once the Fed stepped in and said, we're going to start QE 3, 4, you know, and the whole thing, QE to the max, that's, you know, all of a sudden, all those shorts had to start covering, and they were basically covering all the way up to 2015. And then, you know, then the market started topping out because the market got too confident. You know, it was after 3 years, but nobody saw this rally coming, you know, this mega rally. But okay, what was the other feature of the October 4 bottom? You know, unbelievable negative sentiment. I mean, when you got the biggest short interest in history, you have, by definition, the biggest, you know, potentially a bigger short position, or, you know, sentiment position than 1932. And guess what? The same thing happened in 2016, you know, at these bottoms, not to such a great extent. But guess what? The bottom that happened in 26th of December last year, which you asked me about earlier on. Remember, I said it on this show. The CNN fear greed indicator hit was down to -2, or yeah, -2 because it's a plus minus thing. It was down to -2. I mean, it's never had that reading ever. So, and look, when you see those readings, you just got to go in and buy. And you know, if you remember, it was a very hard bottom to pick that day because it actually went down and made new lows, and then it reversed upwards. And you just had to kind of figure that we were going to, you know, go positive or turn pretty much that day, which is what happened. And the hardest thing about that bottom was, you know, it was like, you know, there was no Christmas rally. You know, we sold off going into Christmas. I mean, that's like the first time since the Depression that happened almost, you know. So there was a lot of really scary things going on with that bottom, and you just have to gauge the fear. And you just have to have the confidence that the market's going to turn. And that's been the secret of this whole rally. And I said on that day, I said, you know, when you see these things, when you see these tremendous extremes, they inevitably not only call the bottom, but they generally, you know, preempt a recovery that's much bigger than anybody can even imagine at the time. And that's what happened in the last 3 months. I mean, we had one of the greatest rallies ever in the last 3 months. It's been incredible. Now, the lesson from that is we had a similar reoccurrence with gold. You know, last year in August, the gold sentiment hit pretty much record lows, and it never went, you know, the short interest by the hedge funds hit new lows. And the short interest on gold, and it was hitting low. I mean, just like the Dow. And guess, you know, this was lower than the bottom in 2016, which at the time at 1046, you know, 10 times incidentally than off the bottom of 1976, 104.7, 104.6, exactly 10 times higher. What does that tell you? If we went from 106, you know, 104.6 to 875 in 4 years on gold in 1976 through 80, and we bottomed at 1046 in 2016, and we're in 2019, and we're 1315 right now, possibly on our way to substantially higher levels. I mean, can we get to 8,750 by 2023 or 2024? I wouldn't rule it out, you know, because the second, you know, well, if Trump does get reelected, look, if the Democrats get elected in 2020, the gold is going to triple from here at a minimum, you know, by 2020, because there'll be a tremendous fear factor about socialism and Venezuela and everything like that. And people see the gold went up 1,000,000% in Venezuela. I mean, they're gonna start, you know, to go up 2 or 3, you know, 100% or a couple of 100% is probably going to be a walk in the park by comparison. But notwithstanding that, almost every second term president has a honeymoon of a couple of years, and then everything hits the fan, and you know, things can turn very bad. And then you've got the early decade of the 2020s. Look, I've said this before on this show. If you go back to the 20th century, 1921, I think 22, you had this. You had the market go all the way back down to almost the 1907 bottom. That would be the equivalent of the market literally tumbling from from where it is today, possibly down below 10,000 again. I know it's hard to reconcile, but you know, it's I have to tell you, it's on the cards, because almost everything that's happened century over century has been, you know, happening on a similar basis in one form or another. It's remarkable. And there was a big rally into the end of the second decade because of the end of the 1418 war, the First World War, and there was a very low inflation. The inflation hit in the early 20s from all the, you know, from all the excesses of the second decade, which I think you could confidently say is the case today, especially with the deficit of 22 trillion and counting, and all the stimulus that's in there. And the casualty was the Weimar Republic in 1923, you know, the hyperinflation. And look, nobody saw it coming, because it went, you know, you had 0 inflation, and then you had 10% inflation, then you had 100% inflation, then you had 1,000% inflation, then you had 1,000,000% inflation, and it happened one year after another, just like that. I think there is a tremendously real risk, given all the debt in the world and all the quadrillions of
what was that last word, John?
potential. Quadrillion?
Oh, okay, I just want to make sure.
Given all the debt in the world and the quadrillion, instruments out there, derivatives that threaten the whole system. If the dollar breaks, if the dollar goes down substantially in the coming years, which I think is quite probable, they have to monetize this debt. They have to get rid of the debt worldwide. The whole world could be the Weimar Republic. In other words, in this, and so the early 20s could be a really tumultuous period where gold and silver could potentially go up and intersect with the Dow at some point, maybe around 8, 9, 10,000, something like that. Could really happen. It won't be the end of the world because it happened in the 1970s. Gold went up 8-fold, and guess what? We have, a couple of years later, we had the biggest bull market ever. So, and that's a recipe for the Roaring 20s, because notwithstanding anything, the innovation going on in the world today is just mind-boggling, with especially with flying cars and automation and everything else. And I have a theory. I kind of thought about this recently. Everybody's like, the smart money, if you like, the Elon Musks of the world, and all these guys are seeing the future ahead of time, and they're saying, automation is going to be a big problem. It's going to put a lot of people out of work. But I think it's not, it's not something that's coming, in the next year, 2, 3. I think what's going to happen is we're going to have a real big, something pretty major in the early part of the next decade, and it could be really tumultuous. The Dow going down, very temporarily. This Dow crash in 1922-3 time was over in a heartbeat. Why? Because the Fed has figured out how to turn these markets around, and I think what they'll probably do is, if there is a crisis, that everybody around the world, the Chinese, the Japs, everybody else, they're all going to go in together. They're going to go all in to get the markets back up, and that's going to kick off what is essentially the Roaring 20s of the 21st century. And then we're going to rally. We're going to have a sort of repeat performance potentially, where we run up into 29, 30, and guess what? That's when the automation is going to hit the world in a big way. And that's going to be our depression of the 30s in this century, where millions of people are going to be put out of work by automation.
How do people prepare for that?
Well, you got to get into a business where people can't be automated. I think that's the best way to do it. You got to figure out. That's the only insurance, and it's probably going to be brutal. I mean, it'll in terms of going through. I mean, look, market wise. I mean, look, we've had most recessions, 2007 to 9, lasted a couple of years. Most recessions last anywhere from 6 months to a couple of years. The Depression lasted 3 years. So, worst case scenario is, from a market standpoint, it might last 3 years. But remember, what perpetrated that was a huge run up in the market, where everybody thought, there was no tomorrow, just like Bitcoin. In other words, we have a Bitcoin run in the Dow, and then the markets, maybe we go to 50,000 or something, or 100,000 even by then, where everybody thinks, there's no, it's like socialism, the utopia kind of thing, where everybody's making out fantastic, and then all of a sudden the whole system breaks down.
Well, I think it breaks down, and I don't mean to hurt anybody's feelings, and not speaking ill of anyone, but these millennials, John, they see the world differently than we did. Do you know how many millennials there are in the nation as of this last count that I have in front of me? Just take a wild guess.
Probably on a par with the baby boomers, or more than 100 million.
You said it perfectly. Okay, when this was tallied up in 2015, I guess, there were 75.4 million millennials in this nation, and there's only 74.9 million baby boomers. So they've eclipsed us. They've eclipsed the baby boomers.
Well, they have to, because eventually when they do become producing citizens, they got to bail out the world of the future with a social security, and that's probably going to be another problem in the next era.
No, because they're being taught that they deserve to get a check even if they don't want to work.
Yeah. Well, look, listen, you're going to have a brutal mindset. Look, the world goes through these adjustments. Why do you think some of the most successful people, billionaires today, a lot of them went through what happened in the Depression, and their parents, were very cautious afterwards, and in the 50s and 60s.
I had aunts and uncles and folks who did go through that, and man, you look in their pantry, boy, they're stocked up. You would think Armageddon's coming tomorrow, but that's just because of what they went through. And these millennials haven't gone through anything. They've had a cushy,
they're going to get tested.
easy life.
They will be tested. They're either going to be tested economically or in a war or something. And you can never listen. The world could erupt overnight. There's so much risk in the world today of something going wrong. Especially with these, this whole situation with Venezuela right now, where the Russians sent in some troops there in the last couple of days, and then there's this China threat, and there's still North Korea, and a couple of other places. The world's potentially in a lot better shape safety-wise today than ever before, but the risk of something going wrong that could just mushroom out of nowhere is something that could just change everything overnight. And also everything that we're so used to today, thanks to all these satellites and everything. If there is a kind of a serious conflict, those satellites are going to be taken out in a hurry, and it's going to really rock the world. That's going to just zap up all our conveniences in a nanosecond. So the risk of the world and the speed at which things could happen in the future is very dangerous. I've told you before about how I feel about the frontier of North Korea, where the most dangerous risk of war still potentially exists, because I don't think it's going to, because of the detente going on with North Korea today. But when things were looking rough there, that guy could have unleashed a barrage of artillery on the Seoul and done a lot of damage in a very short period of time. And this is a war that's fought in seconds, not minutes. You only have a minute if they start, unloading. Okay. So, and I'm very disappointed that that he wasn't, as part of the initial deal, that he didn't withdraw those troops from the border. I think that was a huge mistake, and it would have been people were too focused on the nuclear instead of, paying attention to the conventional, which is still a huge threat today. In return for not doing the exercises, that should have been a minimum requirement to send those troops back to the base, and then they would have known where the troops are. So if they ever sort of get out of the base again, heading for the border, there's trouble. That's what happened in Iraq in 1990. The CIA, not even the CIA saw it coming. When he's invaded Kuwait, because these things can happen out of the blue, and who knows? Look, imagine if there was an earthquake in California that took out half of Silicon Valley or something. It could happen. By the way, that volcano in Mexico recently has been really very, very active in the last week or so. It's been exploding higher. Took out the dome the other day.
Took out what?
So the dome, there was a kind of dome inside it, like sort of a top, which was holding the magma, and then that dome explodes, and it can really, there's the volcanic activity around the world is certainly troubling in terms of where something big might hit at any time. Look at that. What about that meteorite that came in on just 26th of December? I think that.
And that had the power of how many atomic bombs?
10 times, and that's they say it's one of the biggest things that ever hit the Earth in like several centuries.
Incredible.
Yeah. So, you know, I mean, life's pretty good today, but it could easily come undone, and we have to be ready for it.
Yeah, you do. Well, thanks, Sean. It's been a great show.
Likewise. Thanks very much. All the best.
Appreciate it. We'll see you same time tomorrow.
Okay, much obliged.
Take care. All right, friends, we have a Q&A session this evening, 6 p.m. Eastern. I got a bunch of mentoring sessions, and then 6 p.m. Eastern, I'll be there to not put on a presentation, but for anyone who has been on the Logic 247 alert trial, I want to just answer any questions that you might have, okay? If you don't have any questions, I guess you don't have to come, but if you do, then come on down and we'll get you an answer. Fair enough? All right. Let us go, as we do, to our good word for the day, which I have tucked away somewhere. Let's see what we got. Stand by, still checking. Here we go. All right. You know, it says in the good book that they will know us by our love. How many times would someone not know you by your love, right? We all get angry, aggravated, frustrated, probably not even in a good mood when you're constipated. But here's the deal. When other people look at us Christians, as we label ourselves, their thought should be, man, I want what they got. Romans 5:8. God showed his great love for us by sending Christ to die for us while we were still sinners. Human love says, I'll love you as long as you meet my expectations, agree with my politics, attend my church, and fit into my social circle. Thank God, God isn't like that. He did not wait for us to become worthy before making the first move. God showed his great love for us by sending Christ to die for us while we were still sinners. And in doing so, he changed all the rules. Jesus said in John 13:34, now I am giving you a new commandment. Love each other, just as I have loved you. And in Matthew 22:39, love others as much as you love yourself. And in Luke 6:35, love without hoping to get anything back. See, love isn't a feeling, it's a doing. Not a noun, but a verb. It's about giving without counting the cost, without an expectation of receiving anything in return. When Jesus gave us a new commandment to love as he had loved, what did he mean? He meant true love requires sacrifice. Perhaps it will be a sacrifice of time, a sacrifice of energy, or a sacrifice of money. Together, these add up to commitment, no matter what our feelings are, because feelings come and go. Kristen Armstrong says, for a while I was angry at love. Wasn't all it was cracked up to be. It didn't last. It just wasn't worth it. The deeper it went, the more it hurt. Love was irrational, complicated, elusive, and unreliable. And I was just done with it. This is what Kristen said. Little by little, the Lord healed my heart. My anger began to fade. Now I see its humanity that scars and strangles love. Because 1 John 4:7 tells us that love comes from God. And it's worth it, whatever the cost. no matter what damage has been done in the name of love, we're incomplete without it. So today, make it a point to show somebody God's love, just as He showed you. Thanks for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.